Welcome to the HMO Property Show by investors for investors. Brought to you by the HMO Property Co, Australia's leaders in impact investing. Investments made with the intention to generate a measurable, beneficial social or environmental impact alongside a positive financial return. Catch us weekly as we discuss all things cash flow positive property investing.
Welcome back to the HMO Property Show. I'm your host Neil Gibb, and this week I have one of my favourite people from my A team, and we're going to talk about building an A team because real estate isn't just about you going out there and doing deals yourself. You need to surround yourself with experts that can access finance, experts that can help you save tax. And today I've got the amazing, the beautiful Elizabeth Rutten.
Thank you.
Welcome to the podcast.
Thank you so much.
Episode 2. And today we're going to talk about all things finance. And I understand this could be a tricky episode to record because at the minute it's a really evolving sort of beast that's going on out there, isn't it?
Pretty much.
Cash rate is rising weekly at the minute. The finance packages that we have access to in the way of HMO lending is changing daily. So I might get you on more often, and we might review what's going on in the lending landscape, maybe on like a 8-week basis or something like that, because it's such a beast right now. And one of the key factors to being successful in real estate is having access to capital. The less money you can put into a deal and the more money you can borrow from the banks means that you can make your money work harder and harder and harder for you. And I've had a lot of people reach out to me and they say, I can't borrow any more money. The bank won't lend me any more money. And then I say, have you spoken to Elizabeth? And then you wave your magic wand. Not all the time, not everything is fixable, but there's a lot of times when you can actually help people get from where they are to where they need to be, can't you? And you're not just a broker. You're a finance specialist and also a strategist, is that right?
Yeah, correct.
So give us a bit about you. How did you learn all this stuff?
Oh my goodness. Gosh, I've been doing this since 1986. Banking, lending. So I could say I started when I was 2. Working within ANZ gave me the basis of strategizing, technical skills. I have to be honest, I learned the people skills after stepping out of banking and broking. I did that in 2006. And working for different organisations that do different things, i.e. selling off the plan, flying overseas to write the loans for people that live and work overseas.
That would be cool.
Yep, was great. Great time, Singapore, Kuala Lumpur, etc. There was also buyer's agents time that I worked with. Was all negative geared property based on tax effectiveness, yes.
Not going to talk about it on this podcast.
Yeah, working in-house, building company, doing their finance. And after that I worked for probably about 5 years for a entity that taught everything about investing in property.
Which is where we met.
Yeah, and that learned me a really good skill set. Going back to ANZ, it complemented the skill set that I already sort of learnt at ANZ, but that expanded on mainly strategies. That was the real sort of key that I can take away from that. It's strategies. It's not necessarily, of course, finding the right lender, but it's putting the right strategies together to help the client make the next move, but also think about what they want to do after as well. It's not only now.
It's like a game of chess, isn't it? We need to think like 5 or 6 steps ahead.
Correct, I do, because I always envisage, okay, we've bedded this acquisition down now. What are you thinking of doing next? And it sort of gives me a bit of an idea where their mindset is, and that could be, a couple of steps ahead, or simply this. Either way, I respect it and work with that sort of trail of thought as well. And
just going back to the education company that you worked with previously, like a lot of brokers just deal with mom and dad investors. They help them invest in their own principal place of residence. They might buy one investment, but you were working with sophisticated investors, investors with anything from one property in their portfolio to 25, 30, 35. Yes. Hectic setups, structures, and we're going to talk about structures with Nitin Vashisht in episode 3. But yeah, you've seen it all really, haven't you? You've seen the most simple deal and the most complex deal, commercial, resi. Been there, done that, got the T-shirt.
Yeah, absolutely. And I love it. I have such a passion for this line of work. It gives me a great lifestyle, but it also I feel very privileged to be able to help people on their property journey. It's more privilege. That's how I see it. There's perks in there for me, of course, but I love helping people. And I think it's a really sort of great starting point. Of course, I can't help everybody. There's still certain things I have to work with within certain parameters. But, you know, there's always ways to go about making the next step if one is willing to work with me as well.
Well, what we'll do in this episode, I think we'll break down the real basics of lending. What is lending? What's debt? What's equity? Cross-securitization, all the things that we should do, shouldn't do, how to set yourself up best for if you're going to apply for finance in 3 months. We talk about credit cards. There's so much we can talk about, isn't there? And I think that's why you could become a regular on the show, because things are going to evolve. So a mortgage.
A mortgage is actually by definition the charge that shows up on a title, the document that confirms the ownership of a property. A mortgage is linked to a loan. So when people say I have a mortgage, it's what they actually mean is I have a loan. That enables a bank that, when in the event that all communications break down, that yes, technically they have got access to your property, but a lot happens in between. It's not we're just going to sell you up. There's a lot of milestones that have to happen, and lenders are not there to sell you up. That's not what they're about.
Yeah, they lose money, don't they?
But it's just not a good look either. You know, so the actual term mortgage is the encumbrance on a title.
And it stands for death pledge.
Oh my gosh, that freaked me out.
Yeah, it's actually Latin for death pledge.
Gosh.
So yeah, it's the bank essentially control the asset that they are borrowing you the money against by placing a mortgage on the title deed.
Correct.
When we are buying a property, do the bank lend us 100%, or do we need to put a certain deposit down ourselves?
Yeah, we always talk about hurt money. That's such a general banking term, and my apologies if I throw some lender jargon into this as well, and just let me know if I do.
That's what we want. We want the jargon.
But sometimes it can be a bit confusing. A lender will never lend or borrow 100% on a property. There always has to be some hurt money. It can be as little as 5%, and even for certain investment proposals as well, right up to whatever you have in cash available. Most people sit between 80, say 90%. Some first home buyers usually around about 95%. So you'd always have to have funds for associated setup cost, which would be obviously the deposit, stamp duty, buyer's agent's fees, settlement agent's fees, and other potential fees that come along with a proposed purchase, which is obviously different when you have a look at an investment property or HMO versus a owner-occupied property.
So if we need to put, if we're getting a 95% loan from the bank and we're buying something that's $500,000, we need a $25,000 deposit, plus we need stamp duty and associated costs that go with that. So roughly we'd need around 25 plus 15, so we probably need about $45,000 to transact the $500,000
as a rule of
property.
thumb, I usually say about 5% extra.
5%,
of the purchase price.
And that is a rule of thumb. It's not guaranteed.
No.
Yeah.
It's overestimating, actually.
And that hurt money that we put in there, that's also called equity, because the bank provide the debt in the way of the mortgage, and we provide the equity.
Equity, and that can be that you have funds available within your own property in the event that you're buying an investment property, whereby we do a separate loan to extract that equity out. So it can be a equity release loan. We do it as a separate facility, or it can be cash savings. Cash, not cash, but savings as such. Absolutely.
Love cash.
And
equity can be, if you bought a property for $500,000 and the bank value it at $600,000, that means you've had an equity uplift of $100,000. And you can access that $100,000 to then go out and buy more properties. It doesn't mean you get that cash for free. The bank will also increase their security over the property, which means if you were paying, for instance, $2,000 a month on your mortgage payments for your interest, it might move up to $2,200 a month for your mortgage interest, because you've redrawn that extra $100,000 out of the actual loan itself. Big thing I learned when I joined the education course that we were talking about earlier was cross-collateralisation. I couldn't even say it at one point. It's a bit of a tongue twister, isn't it? What is it?
That means that when you have one property and you're ready to buy your second one, third one, fourth one, whatever, that the lender or sometimes a broker actually, under the guise of, oh, you'll get a discount, it's easier, more convenient, what they do, they're linking every property to all lending they hold. Now, that may seem fine until you are looking at selling a property. Mm-hmm. And that can potentially mean that they may revalue your whole portfolio. Now, I personally have had that experience. Of our 9 properties we had at the time, we sold a few. Values had gone down, they revalued, and what I thought I'd get cash in hand out of a sale of a unit in Wembley actually went down to debt reduction of the remaining lending. So, and that is unfortunate what happens when you have cross-collateralised. The bank can and will at times take funds from your proposed sale. Absolutely.
So it means the bank has essentially got control over all of your proprities because all loans are with the same bank.
It's a control thing. Yes, correct.
And it might seem more convenient as an investor or a landlord, to have all your loans with one bank, because then you've only got one bank account, haven't you? It could be really straightforward, but you're giving the banks a lot of control there. And let's say you've got your home loan and your investment loan with the same bank, and the market goes down, and then your tenant moves out and you can't keep up the repayments on that investment property. Your home is then at risk. Is that right?
Potentially, yes. Yeah. And convenient is only really from the lender's end, not necessarily from the borrower's end. It may seem that way, but in reality it's not. If you are an active investor, it is better to spread it around. There has been more education lately that people tend to not do it, but I still see it every now and then, and it makes my toes curl when it happens.
Well, you don't know what you know until you either make a mistake or someone educates you on it. Fortunately, sometimes it's the mistake that a lot of people learn that way. So we've got 2 different ways we can buy. Well, we've got multiple different ways we can buy property, but generally you can buy them in our own name, or we can set up a special purpose vehicle in the way of a trust or a company, unit trust, discretionary trust, hybrid trust. What are the pros and cons of buying in their own name compared to a trust and vice versa?
The strategy of applying a trust structure, as we call it, or personal name with an acquisition, is usually tax and asset protection driven. It can be a lending strategy as well. It pretty much depends on what your portfolio looks like. It is not so that it has to be done as a business loan. It can be done as a normal residential loan, normal residential rates. It is more a vehicle to protect your home if it is coincidentally in a personal name. Yeah.
And again, I've had a lot of people and potential clients as well that have reached out to me and said, my current broker said that they can't do loans inside a trust.
Yeah.
That's interesting, isn't it?
I hear that a lot, and that's lack of education, unfortunately, from the broker's end, unfortunately.
And this, and I'm going to continue to say this over and over again, all the way through every single episode of my podcast. You've got to get the right people on your team.
Yeah.
It will make your life so much easier, because if you reach out to someone like Elizabeth and say, this is my goal, and this is what myself and Joe did when we first met her. We told her we were ambitious.
Yeah.
We said, I remember that first meeting around the kitchen table, and I said, I want to be a property developer and I want to be doing X, Y, and Z. And you were like, yeah, righto.
Thinking.
And then here we are.
Yeah.
What, 7 years later?
Absolutely. And a wonderful journey it has been. To see incredible. Yourselves grow. Yeah, it's been absolutely.
Thank you.
I've been quite proud of what you've achieved. Absolutely.
We couldn't have done it without you. Like you say, you've been there and helped us.
Yeah.
Not just from the mortgage side of things as well, but also advice and friendship, and we become really good friends all the time as well. So
absolutely.
And I value that friendship very much.
Yeah.
We are going to bring Nitin in and talk about buying in a trust. How crucial is it that your mortgage broker, specialist, strategist knows your accountant and has a relationship with them?
Quite often I find when you have questions about trust, and I've just before coming here even, I do things in the background with the accountant, because when I ask the client the question, sometimes they don't understand what I mean. They get flustered, and then I have to revert to the accountant anyway. So to answer your question, it's very important. And I have a very close working relationship and friendship with Nitin, who I've known 10 years now as well. So that's been absolutely wonderful. Yeah. It's one email and it gets organised.
Job done.
Yeah, absolutely. Yeah. Absolutely. Yeah.
And Nitin's been around the block a bit as well. Yeah. And I think you worked together for the builder?
Yes.
Yeah, that's how you know each
Correct.
other, right?
Yeah.
So Nitin's got years of experience in real estate, great relationship with Elizabeth,
Yeah.
very well connected as well, and knows a lot of people. And if he can't help you direct with something,
Yeah.
you can guarantee you know somebody that does.
Absolutely.
Yeah,
Yeah.
absolutely. One more thing on buying in your own name or in a trust. How many properties should we buy in a trust?
That, from a lending point of view, not really. As in, how many properties?
Yeah, should you set a trust up for every single property, or should you just set one trust up and just pile 10 properties in that one trust?
It becomes an asset protection strategy.
Question for Nitin.
Yeah.
Yeah.
It's I can answer the question, but I can't, and I'm not
Yeah,
licensed
yeah.
to do so.
Yeah.
From a lending point of view, yes, it can have implications as well. It probably gets looked at pretty much as you're having more than one property in your personal name. My drive is pretty much what is recommended by the accountant, and
Right.
after discussing it together with me as well. What is right strategy? I've seen recommendations made by solicitors, if the property's small, that you can put a number of them in the same trust. For me as a lender, no difference. I will work with whatever
Yeah.
I need to work with.
So it depends on the advice from the accountant
Yeah.
and the legal team.
Yeah.
Yeah. Okay. We touched on cash or equity required to buy an investment property, but what is the what's the sweet spot when you're buying an investment property? What do the majority of investors put down as a deposit?
I love 80%.
80%.
And usually, yeah, when you start talking about 90% lens and people are looking at flipping either subdivisions or just doing a renovation and on-sell, and you're looking at the 90% lens space, there's lender's mortgage insurance, the once-off premium, which is a cost that you have to take into account, and it's not going to get refunded. When you're doing it as 80% lens, in reality, yes, you do put a larger deposit down, so it can be a bit of a drain on your cash flow. However, it also means that you're not paying that premium, which is a loss and has to be taken off whatever you're going to make out of a deal as well.
And the banks prefer it because there's more hurt money, if you want to call it, in the deal. So they see more skin in the game from you as the investor.
Yeah, they prefer that,
Yeah.
and it gets looked at less stricter as well. Absolutely.
Interesting.
Yeah.
Now, we will just touch briefly on the HMO lenders right now because when we first started this journey, there was no lenders in the market, and it was
Yeah.
really, really tricky for us to get finance approval on new build 6-bedroom HMOs because there was nothing else in the market like it. So
Yeah.
God knows how many plans I give to you and said, please take this to another bank, and you must have knocked on 25 different bank doors and they all said, computer says no. But then you rang me up one day with a real excitement in your voice. I found one.
Yeah.
I found one.
Yeah.
And these lenders came out, and look, when was this? This was 8 months ago, I think, wasn't it?
Early in the year.
So we had access to 2 lenders, which the interest rates were good. It just looked like the perfect package. It was like everything we were asking for from a HMO lending point. But as the RBA cash rates increased, the rates have increased, the lending's changed in it. So is it worth us touching on what it is now? Or is it worth us talking about what it was when it first came out, what it is now, and what it could potentially go back to in the future? I know we can't, and there's a definite disclaimer there that what we discuss now is not set in gold. But when we first connected with these people, we were looking at 3% interest only, 80% lens again. But there was a risk fee at 80%, wasn't there?
Yeah.
So as an investor, we would get an 80% loan from the bank, but we'd have to put 21% deposit down, which was interesting. I'd never seen that on an 80% loan before.
Some lenders do apply.
Yeah,
yes.
right. So what was their thought process behind that, do you think?
Sorry, I can't answer that. I can't answer that.
So I'll take a step back on that one then. So we've got one house with, let's say we build a 4x2 in suburbia. We put one family in there. We've got one rental income coming in from a property. And an investor could buy that 4x2 with a 20% deposit and borrow 80% from the bank. Then we build a 6-bedroom, 6-bathroom house, which has got 6 tenants, triple the rental income of a standard investment property. And then they still add a risk fee to that lending package, which is really interesting. And I know you can't say too much about it. I'm just really putting my thoughts out there. So if you're listening, lenders, hopefully it comes back down in the future and we just go straight back to 80%. But as the cash rate has increased, we've gone from 3% and then it went to 4%, I believe.
It's moved up. It's low fives.
Low fives now, and they've changed it from interest only to principal and interest as well.
Correct, yeah.
Now, when I first had that, I freaked out. I was like, oh man, so many of our deals are going to fall over now. But then I ran into the numbers, and some of our projects are still sitting cash flow positive at 5% interest only, 5% principal and interest, still sitting at cash flow positive. So that just shows the strength of the type of accommodation we deliver. And where do you, and I know you can't give me two, again, disclaimer, where do you see the RBA cash rate getting to, and when do you see it tapering back down? Your personal opinion?
Usually the 3-year fixed rate facilities that lenders put to us are an indication of, and again with disclaimers, of where the variable rate market goes. And it's purely based on how they're priced on the swap rate, 90-day bill swap rate. It is a prediction of variable rate facilities. We've had them going up quite a lot. It was nearly every day that we got. Yeah, my goodness, we used to get a lot of. It's quietened down a little bit at the moment. It doesn't necessarily mean that it's not going to go up or down, for that matter. The strategy of the RBA has been quite aggressive, admittedly, and every consecutive month for the last couple of months it's gone up as well. So I'd like to hope that it will eventually stabilise and that it will drop back a bit. Mind you, I can't really say that the rates are high now. We've enjoyed the luxury of very low, unexceptional low rates for quite a while as well.
They're still low.
Yeah, they are. Yeah.
Outside of the HMO lending area, you can still access investor loans. So what sort of rates are we looking at now for standard investment loans?
High threes.
That's still really cheap.
Yeah.
If we go back 2 years, we were paying 5% when we saw rates drop really fast. And if you thought that rates were going to stay that low forever, then surprise.
No.
But what goes up must come down, and I believe that there will come back down as well, because there'll be a lot of people on the East Coast now that'll be hurting. If you've got $1 million mortgage, that an extra percentage point is added to that, then you're essentially paying an extra $10,000 a year, which is a lot of money on top of your $30,000, $40,000, $50,000 that you're already paying.
Interestingly enough, when we assessed loans, even when the rates were that low, we used to assess them at 5.5%. So that meant that when we had a look at doing a loan for a client, what if the rates would move to 5.5%? Can they still afford it? So in reality, nowadays they're sitting 2% higher, about 7s that we assess at. So there's still some scope there. If someone gets a loan approval for rates to move, what usually blows it out is other commitments that clients make on, and that can be lifestyle, it can be credit cards, car loans, all of the above. And obviously at that point in time, when we look at lending, I don't know what clients are going to do down the track, and it's always hard to take a step back, let's face it.
And talking about them commitments as well, every now and again, finance gets easy, then it gets hard to get access to. And sometimes APRA steps in, and they're the Australian Prudential Regulation Association. Bit of a tongue twister again. And they basically govern the banks. Am I right in saying that? Yeah. So they can come in and make banks put policy in place. And when, probably like 2.5, 3 years ago now, they were literally going through bank statements. And if you had like a Netflix account, or you'd been to the bottle shop too many times, like loans were getting declined based off that basis. Kind of.
That was what was a general comment out there. In reality, probably not quite the case. It's interesting to see what is going on in the media and just general talk out there, social media, whatever. In reality, it's never been like that.
Right, okay.
It's always about discretionary spending habits, and discretionary is exactly that. If a client gets asked, are you able to cut back on your discretionary spending habits? Are you able to? That is not a reason for decline. No lender's ever declined on that basis. There's usually something else going on.
Yeah.
Yeah.
What is the best way to prepare yourself for a finance application, whether this be the first home that you're going to buy as a homeowner or an investment loan? And do credit cards play a big part in this as well? Because I see a lot of younger people now coming up in Facebook groups saying, I'm thinking about buying a property in 2 or 3 years. Should I get a credit card now to increase my credit rating?
It's an interesting comment, and it's out there, and it's been out there for such a long time. And no, you don't need to take out a loan in order to build up a credit file.
Interesting.
I have never agreed and could see that scenario. I've recently had an application of some HMO clients. One client didn't have a credit file. That person never has had lending.
Interesting.
And all I do is just make notes, no credit file, no lending held in the past. So it's not so that you have to have a credit card to show that you can behave yourself in order to buy a house. And I've had clients that have come into the country, I've had that in the past as well, and the more inquiries you do, the more credit cards, car loans someone takes out, it actually affects your credit score nowadays. An active file is probably more than 6 inquiries per year is deemed to be active. And so this client had gone absolutely silly and because he got told they didn't know any better by people at work. Yep. And it actually was a negative on him. And so I had to say to him, you need to just take it easy for 6 months, and we need to then go back in and have a look at your score at the time.
And with a credit card, do they affect how much money we can borrow from the bank?
Yeah, unfortunately, they are a big drain on borrowing capacity.
Yep.
A $10,000 credit card equals to around, I worked it out, about $50,000 worth of home loan lending, which is quite massive.
Wow. Yeah.
Now, I never ask clients to close credit cards beforehand. I always talk to them to see if they can reduce limits if they need to. If it does have an effect on borrowing capacity, can you reduce it? What is a reasonable limit? But don't do anything yet. I then make my recommendations to bring down limits, and then the lender usually agrees on it as well.
Yep.
And that's when I advise the clients that, yep, you need to bring it down and provide me with confirmation accordingly. Yeah.
Perfect. What's the difference between residential and commercial lending? Because is residential for houses and commercial for shops?
Per definition, probably.
Yep.
It is two totally different worlds in the lending arena.
Yeah.
Commercial lending, there's no set rate. If you ask me what is a commercial rate, it is a very hard question to answer. Commercial lending, per definition, is not necessarily shops and could be purchase of a business. It can be unsecured lending, and they're all risk priced and risk based. So the business banker, it is business banking arena where I used to work at before. You look at the proposal and decide, this sounds really bad, in which risk category the client sit, and you price accordingly, i.e. allocate the rate accordingly.
So low risk would have a low rate, and
correct.
someone high risk would have a high rate.
Correct, absolutely, yes.
It sounds a bit backwards, doesn't it? The high risk, though, will charge them more for the money.
Yeah, I hear what you're saying. Correct, yeah. But it is how it works, absolutely. The term is shorter as well. Not always. On average, business lending used to be, most of them are 30 years now, but 15 years is quite normal. They may not necessarily allow you to have the facility. That sounds not right to say it that way. They may review your lending every year as well. So they may do valuations on your property. That can be a condition they put in the loan.
Right.
They may require financials every year. And if they don't like it, they may tell you to move on and find another lender.
And commercial finance can be used in the development arena as well, can't it?
Yeah.
And we'll touch on development a little bit. I don't want to go too far into it because that's another podcast for another day, isn't it? But is it still 4 units or more? We're going down the commercial route, and 3 units or less is still resi?
Yes, however, it depends on... I can do a 2-on-1 in the commercial space as well.
Right.
Depending on the deal, depending on the experience of the client, depending on the whole strategy around it, what counts as the exit strategy. So if someone can show serviceability, as in borrowing capacity for the project that you're doing, taking income and expenses into account, sometimes it can be done on a normal residential basis. When you're actually looking at doing a development facility whereby the exit strategy is to sell certain properties or all, then it has to be done as a commercial deal.
And then there'll be pre-sale components attached to that as well. So a lot of banks want the debt coverage in the way of pre-sales, don't they?
Yeah, it's usually 50% to 75% of the properties that have to be pre-sold. And that's not a pre-sale with $1,000 deposit. It's pretty much unconditional 10% deposit.
Yeah. It's a beast commercial.
Yeah.
It is a beast, total different lending arena from residential. Just back to the HMO product as well, because the lending package that we get for HMOs, a lot of people would think it would be a commercial package, but it's actually a residential package, is that right?
Yeah.
But the valuation component to it is different, isn't it? So that's a commercial valuation.
Yeah.
Which has got an upfront fee attached to it. Now, in the residential space, the banks generally foot the bill for the forgot the word, valuation.
Yeah.
They foot the bill for the valuation, but in the commercial area, the lender or the client needs to foot the bill for the valuation.
Yeah.
And because we've got this kind of hybrid model at the minute with the HMO, because they are looking at the cash flow that this thing brings in, they're looking at comparables, they're looking at all these different things, then there is an upfront fee of between $2,000 and $3,000 at the minute, roughly, for that commercial valuation. So any clients that are coming in the HMO Property Co, there will be that upfront fee. However, because they now use this hybrid model, the valuations are all coming in where we need them to come in, basically, aren't they?
Yeah, we've tried quite a number of them now, and they all have come in. I've had one come in slightly above, actually, a property as well, and slightly above what was actually deriving a rental income as well, which is really interesting to see.
Exciting times.
Yeah, so the lender has developed, it's not a hybrid product, it's still a residential product, 25-year term at the moment. We can go up to 80-90% even, but they hang their hat on the valuation. HMO properties, per definition, in the lending arena, we call them specialised securities. Now, the reason for that is it's like a motel or petrol station, childcare centre. Because they are harder to sell, the general population, it's easier to sell a 4x2 property, whether it's for an investor or a owner-occ. First is a 6x6 better. So the market is smaller, and that's why lenders tend to call them specialised securities. A lot of lenders won't do it. Well, nobody does it. Major lenders don't do it in their residential space. This lender does do it. Commercial lenders do them. The business banking arena of the major lenders do them. Only 50% lends and no construction. And that's where we got caught out a fair bit as well. Yeah. This lender does do construction and refinances and cash out as well of existing HMO properties, or co-living as they're called over East.
So if we go back to the start of the podcast when we said we want to put as little money into this as possible and get the highest return, this product that we've now got access to gives us the ability to do that, which has been a game changer for this business and for the model in general. Can you see any other lenders coming in the market? I know it's only early doors. There's only 2 there at the minute. There's potential conversations of other people stepping into that space now that someone's actually blazed the trail, as they want to say. So there could be more lenders coming soon. Yeah,
there's one that I've got a scenario sitting with at the moment that they've got, as we call it, workshopping with credit. So they're looking at my proposal to see if it's attractive for them to take on. But then it's a matter of what term am I going to receive, because it is a commercial lending space. What is the rate going to be, and you know, what other curly bits are attached to it as well, because it's deal by deal that they look at it.
Yeah. And look, it was only a matter of time before the lending changed around this product. I mean, me personally coming from the UK, I'm not sure. So you're originally from Holland as well. So I don't know if it's HMO in Holland or...
Yeah, you know what, as students, young people study in major cities whereby they live in these stately homes with a bunch of other students. It's not per definition student accommodation, but it is living in HMO style. They have their own little apartment, micro apartment within a bigger house, but they do share bathrooms actually, and kitchen, etc. as well.
Yeah, great.
Yeah.
I wonder what the lending's like over there, because in the UK, there's heaps of lenders that lend on this type of product.
Don't know.
Yeah.
I honestly don't know. Yeah, I don't know.
I am going to get some English HMO investors on the show.
Yeah.
And hopefully they'll be able to give us a bit of insight there. So if we know any Dutch HMO investors.
Yes, yeah.
Might have to get you on to translate.
Yeah.
Last couple of questions. Can I buy a HMO in a joint venture with somebody else?
Now, it depends in what way you're asking that question and what the proposal is. Is the joint venture between somebody that has got borrowing capacity and the other party may have the cash to complete the deal? And that then it comes back to strategizing. How do I strategize the application in such a way that I present it in the best possible scenario to the lender? So to answer the question, potentially yes, but we need to chat about how that's going to pan out and how that's going to look.
And we bring in knitting and
absolutely
legal teams.
There's docs in the background that has to be done.
Yeah. Never do a joint venture without legal documentation.
Oh, absolutely. Oh, my goodness.
I've seen a few joint ventures go wrong.
Yep, unfortunately.
New build HMOs, when do the repayments start on the loan for a new build HMO?
As soon as the land settles, because obviously there's stages to a new build. You have your land first and then you have your progress payments as the building construction progresses.
Yep.
5 or 6 stages, I think it is usually.
Yep. 6, I think.
Yeah, from what I've seen. So as soon as a block settle, which has to settle first, it's usually interest only.
Yep.
And the first payment starts a month after settlement of the block.
Cool. So we pay the interest component on the value of the land only.
What has been drawn down,
Yes.
loan amount wise.
Okay.
Yes.
So if we need $300,000 for the block of land and we draw down that $300,000, we'd start paying the interest only component on that $300,000.
It will be a percentage of the 300,000 because the hurt money still has to be in at that level as well.
Yeah. And then as the builder progresses through the construction period, they're going to pour the slab, and then they're going to give you, as the client, an invoice.
Yeah.
The client then passes that on to the bank, and the bank will release the funds to the builder.
Yep.
Once them funds are released to the builder, then that interest component for that slab then gets added onto your land component.
Yes.
So as we progress through the build, it gradually increases the holding cost over and over again.
Absolutely. So you have to have a buffer available to cover, because there's no income against it.
Correct.
And so the best way to work it out, I usually get asked, how much is it going to cost, which is a very difficult question to answer because how long does it take for the builder to put the slab down, to put the brickwork up, etc. So I guess rule of thumb is what I usually do is take the full proposed end loan amount at today's interest rate and then have that set aside as a buffer to cover for the interest only payments.
Good rule. I'll quickly go through them drawdown stages for people just in case they're keen to know what they are. So you'll be slab down, then we call it plate height, which is essentially top of the bricks. And I'll only do this of single story. So plate height, roof cover, where they put the frames on, and then the roof cover itself. Then we go lock up, where we get render internal walls, glass in, doors in, and basically lock the house up. Then we do internal fixings, so they put kitchen cabinetry, bathroom cabinetry, bit of flooring down. And then the final payment would be practical completion, where you would meet the builder on site and go through any defects and create a list of outstanding work that needs to be done. And once that work is then complete, the last payment would then be given to the bank. The bank would then pay the builder, and we're now at practical completion, and you get the keys to your nice, shiny new house.
Yeah.
And if you're an investor, that's when the cash flow starts coming in. So that, like Elizabeth said, the money that you've set aside to hold that property during the construction period, all of a sudden the money that starts coming in from your HMO covers your mortgage payments, covers all your property management payments, covers all your outgoing bills, and then puts money in your pocket, which is exactly how an asset should work, isn't it?
Yeah.
Give me 3 top tips for somebody that's wanting to start investing.
Are you talking about finance? Because that's what I'm the specialist in.
Yeah, do it. But the thing is, because Yeah, give me finance. Top 3 finance tips for somebody looking to
Be
invest.
prepared. I do find that people like focusing on the sexy stuff. I know I do the boring stuff. And going out there looking for property is the exciting things, but get your base right, and I call that getting market ready. That means having had the chat with the accountant, having make sure that you've got your deposit available, which may mean having the savings in place, having the funds come from overseas, having the equity release done before you make an offer on a property. There's nothing worse than coming to me and saying, I've made an offer and it's not quite at that stage yet. There's other things that have to be done, and it happens so often. Yeah.
I think I've been guilty of that before.
And a lot of people do it, unfortunately. So trust structures need to be set up properly, and deposit needs to be associated set up, because that's getting market ready. The other one is when we ask for information, and I ask for your most recent 3 pay slips, please do not give me pay slips going back to February or March. I'm asking for the last
Just
3. Yeah, but three recent ones.
Mm-hmm.
I can't do anything with dated information. When a lender, and it doesn't matter who it is, asks for the last 3 months of transaction account statements, please don't give me Excel spreadsheets or ones, that go back again to early in the year, because the lender only issues them half yearly, which we all know because that's what we do. So it also helps to go through internet banking, have a look at transaction history. If I then ask for a original statement to match it off, there's reasons why I do it, to see that the name and the account number match off. So please give us exactly what we need, because I quite often have to go back and ask the same question again. And I know it frustrates people, but there's a reason why I'm asking for it.
If you give you what you need, they will get what they want faster.
Correct, yeah. And time is ticking away.
Yes.
That is the issue.
Exactly. So when we put an offer in on a property, we have a 28 to 30 day finance clause. So that means you've got 30 days to get your finance approved.
Correct.
And if you just drip feed information to your broker, you can't then point your finger at the broker at the end and say, you didn't get my loan fast enough, even though you only give them the last statement 2 days before the finance needed to be approved.
Yep, unfortunately.
Had that before?
Yeah, and it happens a lot. Unfortunately, that clients think, I've got a month, and don't, get working with us, whoever it may be, quickly enough. And it's nerve-wracking for both parties, because it's not a good feeling.
Yeah, sure is. Elizabeth, I absolutely loved this. I think because we've got such a good relationship, it felt a little bit weird sitting down and putting the headphones on, didn't it? But, I'm loving being back in the podcast suite. Loving having you on the show, and we're definitely going to do this again. So thank you very much. Join us again next week on the show. We're going to be speaking to my superstar accountant, another one of my A team, Mr. Nitin Vashisht. Thank you very much, and see you next week.
Thanks for listening. Make sure you tune in the same time next week so you stay up to date with all the cash flow positive property updates.